Palantir stock is up 400%, more than 400% in the last 12 months. It's gone up to a market cap of $350 billion. Should you buy it? Definitely not. You should stay away from the stock. Do not buy the stock. You will burn money buying the stock right now. So let's get into it. What's up with the stock? It's currently valued at $350 billion. It's ranked number 27th in this world index of market caps, largest companies by market cap. It's ranked 27th. That's crazy. Okay, this company wasn't even in the S&P 500 a while ago. So let's just take a look. It's gone up from a low of $13 billion in December last quarter of 2022. And today is at $350 billion. Should you buy it? Definitely not. Why would you buy this after it's gone up by 2,000%, more than 2,000%? That's not how you make money. That's how you lose money like an idiot. You look at companies that are stocks or whatever, crypto that's gone up a lot, and you think, well, if it's gone up by 400%, maybe it goes up by 100% more from here, and I'll make 100%, and then I'll get out. So that's how people are thinking. Uh, I have studied people who lose money in the stock market, and the reasoning behind FOMO. It's mostly emotional. It's definitely nothing to do with logic. But yeah, most people who burn their money in the stock market are usually buying high because they think, yeah, it's going to go up very quickly by 100% more from this point. Because if, well, in their logic, if in the past 12 months it's gone up so high, and I don't know, they're trying to time the market, or they're trying to put the timestamp. So logically, it could gone up by easily by 100% more in the next 6 months, because in the last 12 months it's gone up by 400%. So that's a little magic. Okay, you're trying to make some magic with the numbers. It's basically, I don't know, same substance as astrology, looking into the stars to predict the movement of the stocks. Which, I mean, let's take a look here. Just a couple of months ago, in February 18, it started to dip, and it dipped hard. Went down by almost 40%. That's in what, less than 3 weeks or so. So what are we talking about? You can lose 40% of your money in less than a month. Okay, easily. But I think you can lose a lot more. And there are other types of amateur investors that are watching videos on YouTube, getting hyped up, and they're thinking, oh, yeah, everything sounds amazing. The story is amazing. I'm getting so emotional. Wow, I want to invest because some loser on YouTube said I should invest my money. But I have no proof that he ever made money in the stock market. He just talks about stocks, so he must be an expert. And you get hyped up, and what's going to happen? You think, oh yeah, I'll just buy this and hold it for 10 years. Well, let me show you what can happen if you buy this after it's gone up a lot. Let's take a look at Tesla. So here, if you wanted to make money with Tesla, if you believed in Tesla, and if you had a solid feeling for where it's going to go in the future, you would have bought low. 2018, 2019, you would have accumulated strategically, you would have accumulated stock in this company, and then you would have sold once it's gone up, not bought after it's gone up. After it has gone up by a lot, it mostly went sideways with brutal swings. I mean, look at this. Let's take a look here. What type of swings Tesla had? It's gone down 70% in one downswing. Okay, that is insane. Another one, 50%. So the swings are brutal. 150% up, 200% up, 40% down. I mean, this type of swings, you definitely do not want to have a huge chunk of this of your money invested in this. Yeah, sure. It goes down by 70%. You think, oh, that's a good buying opportunity. Buy it low. Okay, buy here, sell it somewhere here after you made 100%. or buy it again here. Don't buy it when it goes vertically up, okay? When it has vertically moves up, okay, makes no sense. Look at Palantir. It's basically a vertical move up, but the timeline is not adjusted. But you will see that it's not going to end it well for many people who are buying into this bubble. Let's take a look at this stock fundamentals. What's driving this hyper growth in the stock price, in the market cap? Uh, okay, so just two numbers here. P ratio 650%, forward P 200%, revenue growth. Let's see, is it this high, growing at an incredible number? 600 billion in 2018, and trailing 12 months now today is at 3 billion. That's not hyper growth. That is not exponential growth. It's just decent growth, okay? Let's take a look at the numbers. Revenue growth year on year at the percentages. 24%, 25, 47, 41, then drop down 23, 16, 17. So when it goes up from 47 to 16 and then accelerates, I mean, this is not consistent at all. It can go up again from 33 to maybe 40% from here on out, but it can also drop like it did here. So this is not consistent. You cannot rely on this type of growth. It can also drop. Let's take a look at some other stuff. Yeah, shares outstanding, shares change year on year. 2022, 7% added. 2023, 11% added. Last year, 6% added. I mean, Jesus Christ, the stock price needs to go up by a lot just for you to break even on your investment. This is crazy. This is what, 13, 24, or almost 30% in 3.5 years. 30%. The stock price needs to be to appreciate just for you to break even, my friend. Just because they dilute the shares, they add more shares. Why do they add more shares? So that they can get money from idiots that invest into this company. Okay, you buy this company, they dilute you, they make your shares worth less and less, and then they cash in on that money. They make some other type of investments. They pay the shareholder, the employees, the management. That's how you get suckered. Okay, that's how you pour your money, your hard-earned money, and the smart guys are taking that money and pocket it. Okay, gross margins, software like gross margins, 80%, nothing impressive. Don't look at this and say, oh yeah, it's very high. All of the software companies are very high in gross margins. Okay, you need to be impressed by operating margins, which I don't see anything impressive here. A couple of years ago, they were hovering around minus 100%, minus 80, more than 100% minus. So yeah, they're improving 5%, 10%, 13. This is not impressive. They're not growing as fast as I would like to see. And especially not at this PE ratio of 600. Okay, this is not consistent growth and it's not fast growth. Okay, this is not improving fundamentals fast enough for me to ever consider buying this. Okay, balance sheet. They're gonna have a lot of money on the balance because they have diluted the shares. So they raised a lot of money by diluting the suckers that have bought into the stock. So they're gonna have a lot of cash on hand, not a lot of debt probably. They don't need debt. So yeah, they have net cash of $5 billion, which is great. So their cash growth is growing, growing, growing. because they dilute. Let's see, cash flow, net income. 2020 they were losing 1 billion, so they're net income positive. They are profitable. Trailing 12 months around 600 million. Stock-based compensation, let's see here what's going on here. More than a bit, $1.3 billion 5 years ago, which is insane. It's just 5 years ago when the mania started, they said, yeah, let's cash into these idiots who are buying into our stock when it's worthless. Yeah, so yeah, they kept offering more than $500 million to the management and the employees, which is crazy. 700 million lately in the last 12 months, trailing 12 months, which is a bit excessive for this type of company because it's not bringing in the cash. Okay, it's just not producing the results. I'm sorry, but it's just not. It's all about the stories. It's all about the hype and what's it gonna be and the huge. Oh, AI. Invest in Palantir because of AI. Don't look at the numbers. Let's take a look at the market cap again. 13 billion. So look at just five numbers, starting with a one. And now you have six numbers starting with a three. Would you like to invest in this, sir? It's not growing much at all, but yeah, it's growing, but not. If this would have gone up from 13 to a market cap of 26 today, I would say, yeah, that's decent growth in line with the statistics that we have just seen with the top line growth and other metrics, and with the fundamentals improving at a slow growth. You would say, okay, going from 13 to 26, that's okay. That's a normal inline growth with the company, okay? But 13, yeah, that's kind of crazy. Price to sales 109. You're paying you're paying 109 times, not for the earnings, for the sales, for the top line, for the revenue. So every dollar of revenue that this company has, you're paying 109 times. Wow. That's so insane, dude. That's how I don't know how people can buy this. It's EV to EBITDA 800 times. Jesus Christ. I have seen some I have seen some very expensive stocks, but they also growing a lot. This is not growing very much for this type of price. I mean, this. Let me show you. Just take a look at something I would buy. What does a high quality company look like for me? Let's take a look here. So, revenue growth 1.8 billion, 6 billion. So it's not high, it's not very high growth, but it's very consistent, stable growth. And this company is also much more mature than what we just looked at CrowdStrike and the others. Shares change, shares outstanding, dilution. What's going on here? As you can see, it's in the green. What does this mean? It's with minus. It reduces the share count. Okay, shares outstanding are going down. As you can see, they are profitable and they return value to the shareholders by buying back stock. Okay, they have excess cash, they have free cash flow, and they buy their own shares back. They buy back their own shares. So what does this mean? This means your shares become more valuable. Let's take a look at gross margin. So 80%, nothing impressive. Okay, when you see software like margins, you see gross margins of 80%. Yeah, that's nothing impressive. Pretty much all of them have around 80% gross margins. But as you can see here, operating margin, it was at one point at low, at 2%, 3%, okay? But it grew higher and higher and higher. Now it's sitting at 31%. If this company dips, I'm going to be buying it like I did. And I'm going to show you when I bought it. Okay, this is a very high quality company. Profit margins 30%, free cash free cash flow margins 33%. Balance sheet. This type of companies are usually don't have anything. They don't have a huge debt. They don't need a lot of debt. They don't need to go into debt. They're not capital intensive, capex intensive companies. So net income, let's take a look. Yeah, they're raking in a lot of profits, 1.9 billion. Stock-based comp, look at this, 200 million only. Compared to the net income of 1.9, that's a little bit more than 10%. And compared to the top line, which is more than 6 billion, that's nothing. Okay, let's take a look at Palantir again. $700 million net income, 3 billion. Net income, sorry, net income is 570. So they're awarding more money to their own management and employees than they ever consider giving back to you. Okay. And you would say, oh, yeah, no, because this is going to grow a lot more. Well, I don't care about stories. I want to see results now and valuation now. I buy based on the numbers and based on what the company does now. Yeah, sure, I'm looking at the past as well, and I can predict a little bit in the future, but I can predict, I don't know, 12 months, 24 months. I cannot comfortably sit here and say, oh, yeah, these type of numbers, yeah, they're good. These are predicting hyper growth in the next 10 years. Like Kathy Wood is coming and hyping you up to buy her ETFs. No, this doesn't predict anything. This predicts uh, something mediocre. Okay, this is a mediocre growth. This is not hyper growth. And definitely is not a high quality company that you would like to own. Let's take a look here at Fortinet, some other metrics. Forward PE 41, a lot more sensible. Price to sales, just 13. Okay. EV to EBITDA 36, which is very, again, it's rich, it's high, but this is a very high quality company. Okay. You're going to be paying the price for this company. Look at this return on capital invested, ROIC, growing and growing and growing. And now it's sitting at the 60%. Return on capital employed, growing and growing, and now it's sitting at a very high 33%. This is a high quality company that is still growing consistently. I would like to own this. Any dip into this company, I'm buying.